Good afternoon, everybody. I'm David Pipe. I'm here with Rob Kent, and each week we talk about real estate and mortgage issues that might be important to you. Have you ever gone through the mortgage process and been asked, by your mortgage person, your bank, mortgage agent, or your broker, fixed versus variable, which one do you want? And have you sort of sat there and looked at yourself or looked at your partner and said, I don't know, I guess fixed? Well, it's important for you to know that there are differences, and you can make really great money decisions by understanding what goes into that, what are the differences, and which one you should choose. So we're going to try and help you do that today. Um, for those that don't know us, my name's David, and I'm a local mortgage agent based here out of Guelph, Ontario. I'm here with my co-host Rob Kent, who's a local realtor, also based out of Guelph. We serve clients all across Southern Ontario with real estate and mortgage needs, and we're happy to help sort of share some information with you today. So Rob, I know that this is mostly a mortgage talk today, so probably
Yeah.
I'll be doing a lot of the talking, but
Yeah.
how much does this happen for you to get clients come, and do you guys ever have that talk? Do people ask you for your advice? What happens?
Uh, so for mortgages and variable and fixed, I would say not. The topic doesn't come up very often. No, I mean the extent of my talk with financing is when that's one of the first kind of pre-qualifying questions you have for somebody is because that's always a good place to start is financing, right? Have you talked to your bank? Have you talked to a mortgage broker regarding financing in your mortgage and that? And other than that, I don't provide very much advice with regards to variable and fixed because, like you're probably going to get into, there's pros and cons to both, and it just depends on what it is that you're looking for. So, David, with that, give us a little bit of a breakdown of the
Yeah,
difference
yeah.
between.
I don't mean to put you on the spot. I just thought, it's
Yeah,
one of those topics in the finance world or in the real estate world that ends up
yeah,
being sort of a dining room topic. It's hey, sitting around the table, thinking about it kind of topic. It's one of those things that everybody has some exposure to. So, it's nice to just get a sense of like what people think. And I think all of our neighbors and friends and family have, if they bought a house, they've been exposed to it. But
yeah,
before we talk about what's the best, it's probably worthwhile to just understand the differences because I think that will give people a really good sense about which one might fit them. So, why don't we just start with the big picture? And the
yeah,
easiest way to look at this is fixed versus variable rate mortgages. So if you've never heard of that before, what we're really saying is when you get a mortgage with your lender, with your bank, you have the choice in most cases of deciding whether or not your interest rate is fixed. That means it stays the same for the whole term of the mortgage, for the whole, say, 5 years or 4 years or whatever length of mortgage you book, or variable, which means it can move up and down. The interest rate will move up and down with the Bank of Canada rate for those viewers here in Canada. And there are some, even within those, there's some differences between true variable rate mortgages and adjustable mortgages. But let's just keep it simple for today and say that in general, if you have a variable rate mortgage, your payment will normally change when interest rates change. Okay, so that means that if the interest rates go up, your payment will automatically go up by a little bit, and if interest rates go down, your payment will go down. On the fixed side, it's exactly as it is from the first day until the very last day. Your payment doesn't change, your interest rate doesn't change. So the other thing that people don't often know is that it's about 80% of Canadians choose the 5-year fixed mortgage. It's a pretty high share of people who get the standard 5-year fixed. But what a lot of people maybe don't know is that there's some other things that go along with that are important. And if you've ever had to sell your house partway through the term, or you ever wanted to refinance, or ever wanted to make a change to the mortgage, that's probably when you notice the differences, the most prominently. So aside from the rate being fixed, and we'll get into the differences in rate and itself, but there's a couple of main things that people need to know. So number one, in a fixed rate mortgage, the promise you're making to your lender is that you'll pay all the payments over the next 5 years, for example, and they're making a promise to you to not change the interest rate. Now, that basically has the impact of, building in a bit of it's almost like an insurance factor. So what I mean by that is they're going to charge a little bit higher on the rate than you would normally see on the variable, because there's a risk that the bank or the lender is taking on, right? They're taking on the risk that if rates go up, that they're not going to charge you anymore. So you normally see a little bit of a premium on that. And in today's world, it's normal right now. It's around half a percentage point, maybe a little bit more of half a percentage point. So for those on a 5-year mortgage, that half percentage point, if your mortgage is say $500,000, we're talking about $2,500 a year of difference in the interest cost. So by month, it's around $200 in this example. So savings of $200 is significant. So it's something to be aware of, where the fixed one will have a slightly higher cost up front. Of course, if rates go up, the variables cost will increase. One thing that is also really important to know is that along with that promise that we mentioned earlier that you're making to the lender, there's a cost for you to break that promise. And people talk about this as the term is called prepayment penalty, but it's also just called like the break fee. So if you wanted to break your mortgage, that includes if you sell the house, if you want to refinance the mortgage. So refinance is just like breaking. That means I want to get some additional funds out of the house for a renovation, a project, an investment, debt consolidation, any reason you want to take money out midway through the process, that's a refinance. And that counts as a prepayment, even though you're getting more money, which seems odd. So if for any point during the mortgage, if you want to make a major change like that, the bank is going to impose a fee. And those fees vary. The big 5 banks in Canada have a more complicated way of calculating it that usually means the penalties are a little bit higher than some of the non-bank lenders. But every contract, every mortgage is a little bit different. And you as a buyer, as a homeowner, should ask your lender about how the prepayment penalty works before you sign for that mortgage, because that can make a big difference in whether or not the fixed rate mortgage is right for you. As an example, there are clients out there with maybe a $500,000 mortgage, and if they were to break that, say 2 years in, the bank's going to essentially say, well, you promised to pay us 5 years at this rate, and now we have to take this money we lent to you and we have to go lend it out at a lower rate to somebody else. So we're going to lose money. So we're going to charge you basically that difference. So that penalty can be thousands and thousands of dollars, depending on your contract with the bank. Flip to the variable side, they do have penalties as well to break a mortgage. We're not talking about open mortgages. That's a whole nother topic. We're talking about a fixed rate closed mortgage. That penalty is limited to 3 months of interest. So on a 5-year mortgage, whether it's the first year, second year, or fifth year, well, not fifth year, but the last year, the penalty to get out of that mortgage, to refinance, or if you had to sell, is limited to 3 months of interest cost. So where in our other example, we have, it could be $15,000, $20,000 or more or less, depending on your interest rate situation. In a variable rate mortgage situation, if you were paying, 1.5% or 2% on your variable rate mortgage, and you had, say, like a $500,000 mortgage, your annual interest costs we talked about were, I think we said $2,500. No, sorry, that was the difference. But 2 on 25 is $10,000. So the 3 months interest cost would actually work out to be about $2,500. So the penalty on the variable rate could be a tenth or less of what you would see on a fixed rate mortgage. So again, that may not be important. Yeah, that's a massive difference. And it may not feel important at first because everybody says, oh, I'm not going to move. This is our forever home, or, we're not going to make a change, but family situations change. Your family may grow, your job may change, you may want to move, you may want to renovate. In today's market, everyone's renovating because housing prices are going up. So while I said the vast majority of people take a fixed rate mortgage,
Yeah.
almost 2/3 of them don't make it. Sorry, only about 2/3 of them make it to the 5-year mark. So that means 1/3 of people who book a 5-year fixed rate mortgage will actually need to refinance or break that mortgage and pay that penalty before the 5 years is up. So if you knew that going in, you may not opt to take that fixed rate if you had known that the penalty was so high,
Yeah.
right? So those are the big differences. So let's get into the question of like what's best for you. So assuming you have the choice, because with most banks you do, you have to ask yourself about your timelines and be honest with yourself. So number one, really have that conversation. If you're buying by yourself, have it internally. If you're buying with a partner, spouse, wife, husband, whatever, have that conversation about like, okay, how committed are we to this particular house and to this particular mortgage for the next 5 years? Because the penalties are high. The second thing you need to ask yourself is really about your comfort level. You know, I give people advice on which one is the right one all the time, but ultimately it comes down to, you know, how do you feel? How would you feel if interest rates went up and your payment changed? So if you're the kind of person that is very budget focused and, you know, you're watching every dollar in and out of your accounts because, you know, you like to have that control over your situation and your income is fixed or your income is set up in a way that it makes sense for you to know exactly every single month what the cost of that mortgage will be, then a fixed rate has things about it that are attractive.
Right.
If a little bit of flexibility wouldn't bother you, like, oh, hey, my payment went down by $50, my payment went up by $50. If that wouldn't bother you and you wouldn't lose sleep at night about, you know, Bank of Canada rate announcements, then, you know, variable is something that might fit in with your situation. So, you know, people often ask me, hey, well, if I go back in time, which one should I have chosen? Right. And in any given moment, you know, Rob, you and I won't know what's going to happen with interest rates next year. No. We don't know. I mean, in today's environment where we are in 2021, everyone says they'll go up and they will. But when and by how much, we don't know.
Right.
Right. So without the crystal ball in hand, the long-term history of fixed versus variable, it says that a variable rate mortgage ultimately will save the client money in the long run. Yeah. But there's a but. There may be times throughout that mortgage, you know, periods of a couple of years here and there where it was better to pick fixed, right? Because of the change in interest rates. And so a lot of people look at me today and say, well, interest rates are at such a low amount or historically low. You know, you can get a fixed rate mortgage in the, you know, low 2% range. Why would I ever take a variable? And that does make sense. So maybe that's the right choice for you right now. But in the long run, over the course of your, say, 25-year mortgage, or maybe it's a 30-year mortgage or less, if you had picked variable every single time, you would have been better off than if you'd picked fixed every single time. Purely financially speaking. I don't know if your stress level would have been higher or if it would have bothered you or whatever. But for that person that doesn't move, that stays in the house the whole time, the variable will save you money in the long run, historically speaking. But it always comes down to what makes you feel good, how, you know, what makes you sleep at night. And if an increase in your payment, you know, that goes along with a bank rate increase would cause stress for you, then it's worthwhile to know that the fixed rate option is still there.
I think that's why a lot of people, like you said, 80% would pick the 5-year fix, is because like people don't like change and people like just knowing what they're going to pay, right? As long as, you know, they're comfortable with that, right? So you find out, you know, your mortgage is going to be whatever, $1,500, $2,000. They're like, okay, yeah, I'm good with that, right? Knowing that it's not going to go up, not going to go down, right? With the flexible. But are the banks telling them about, you know, the penalties that come along with this, right? I mean, that's a great question. And I don't want to, you know, I'm not going to, you know, I just don't remember hearing that in the three different terms I had a mortgage. I don't ever remember hearing about penalties, right, from my bank.
Right.
So
right. So again, we as mortgage agents are required to disclose these things to clients and to share this
Yeah.
information. I can't say what happens in every mortgage meeting. I know myself getting mortgages that if I had understand the real difference, like I knew there's a penalty, but if
Yeah.
I had understood the real difference between the penalty on the fixed and the penalty
Right.
on the variable in my specific scenario, I would have thought very hard and long about variable in a bigger way. In a lot of cases, sometimes we did pick variable.
Right.
But yeah, I think that certainly asking that question. So the only person that's really looking out for, you in that situation is yourself, and always ask
Yeah.
that question. If you don't
Always.
understand, pause that conversation and say, help me understand what the penalty would be to get out. Okay, so that's ultimately important, because aside from that guarantee of rate, there's a real big difference in the flexibility that people need to be aware of, right? That's really what it comes down to, is flexibility,
Yeah.
And so we'll throw one more thing into the mix here, and then we'll call it, because our 10-minute talks always go longer than 10 minutes.
Sure.
So one other thing that you need to know is that if you pick fixed, you're stuck with fixed for the 5 years or whatever your term is.
Right. Yeah.
If you pick variable, you can switch to fixed. You can
Right.
lock it in later on
Yeah.
with almost
Yeah.
every lender. So what that
Right.
means is, if you have a 5-year variable rate mortgage, and after 2 years rates start to creep up and you say, that's it, I can't take it, I want to lock it in because
Yeah.
I feel like that's the right thing to do. First,
Right.
get some advice on that. But you can lock in as long as you do a couple of things. Number one, you have to stay with the same lender you're with. You can't lock it in with somebody else. Okay? They're not going
Okay.
to allow that. Number
Right.
two, you cannot lock it in for less time than you have remaining on your existing mortgage. So if you have a 5-year mortgage and you're 2 years in, that means
Yeah.
you have 3 years left on that contract. You
3
have
years
to lock in.
and fixed. Yeah. Okay.
You have to lock in for at least 3 more years. You cannot
Yeah.
lock in for less. So the bank's not going to let you shorten the time you're committed just because you changed. But
Yeah.
you can make that lock-in decision at any time you want, and the
Yeah.
rate you'll get will be the best fixed rate at the time that you make the lock-in decision. So you're not going to get the fixed rate from 2 years ago,
Right.
right? You're not going to lock in at your current variable rate, because that's what people
Yeah,
think. They can
yeah.
just lock it in. You're going to
Yeah.
lock in at the best bank fixed rate that they can offer at that time. So it will
So-
change.
Well, so I got a question for you, because I mean, typically they'll have different fixed rates based on 5-year, 3-year, whatever, right? So now, if you're locking in for the remaining 3 years, not 5 years, are you getting the 5-year rate, which would typically be a little bit? Well, no, I guess the 3 rate be better, or would the 5-year rate be better? 5-year rate
That's-
would typically be better, wouldn't it?
That's a good question. That's almost like a whole other conversation, because
Yeah,
that
sorry.
depends. So fixed rates are fed by the bond market, and that depends on what the expected future is for rates. So right now, the shorter term rates are lower. So right now,
Short-term rates are lower. Okay. Yeah.
right now, yeah, like a 2 or 3 year mortgage you can get for less than a 5-year. Okay.
Right. Okay.
It's
Yeah.
that's not always the case. So
Yeah.
to answer your question, you would be getting the rate that matches up with the term of your commitment. So if you have 3 more
Okay.
years, they're going to give you a
Yeah.
3-year. Now,
3-year. Yeah.
you could sign at that time for a 5-year. You could say, okay, we've done
Right.
2, we'll sign for a 5-year, and that will really be like a
Yeah.
7-year. But that would
Right.
be the way to get the 5-year rate at the time.
Yeah, yeah. Well, and maybe that might be, if you're seeing the rates creeping up, that might be the the way to go, right? Because you don't know after that 3 years is up what the rates are going to look like, right? So
Right. So
Again, peace of mind, right?
your lender, and every lender has a little bit different policy. So you have to, ask the questions, or speak to your mortgage agent or your professional that you trust. But you will need to know that lock-in process has a couple of criteria. So again, you can't change lenders. You can't say, well, I was with bank X and now I want to move to bank Y. And you can't have less time remaining on your new locked-in mortgage than you had remaining on your fixed.
yeah,
So, in summary,
Yeah.
of course, which one is the best for you? Well, it depends.
Yeah.
If you're an investor, maybe you want a fixed rate because you're managing your cash flow. Maybe you want a variable rate because you're a flipper, because you're going to flip that house and the penalty will be high if you book a fixed rate
Yeah.
mortgage, right? So you book a variable rate mortgage to minimize your penalty. If you're a growing family who just moved to a new town, maybe some flexibility might be important to you because, hey, we just moved to a new town. Maybe we'll find that we love this neighborhood and maybe we'll find that we don't. So we want to maybe make a move in a couple years. Maybe we might have kids and we don't know exactly what the timing might look there. So when flexibility is important, when you have life changes that could be happening, the variable rate can be really valuable in giving you that flexibility. Or like I said, if you have, a desire to sort of like be mobile, right?
Right.
If you're basically not going to move or not going to sell or not going to refinance and renovate, then a fixed rate can be really attractive because it can help you manage and understand your payment every single month. So a couple of things to think about. Fixed versus variable. Penalties are very different. Flexibility is very different. It's really about your comfort. So with that being said, I think that sort of sums up the main differences. Rob, did I miss anything?
No.
Sounds good.
I think, you covered off a lot of stuff there with the fixed versus variable mortgage. And,
in a very short period of time. So again, if you have questions about this specific to your scenario, or you want to talk with a realtor about what is the right house for you, how you should go about getting into the housing market, you have a choice. You can contact Rob directly. You can contact myself directly. Happy to help and answer questions. We come on here regularly to just share information. It's free of charge, and just hope you enjoy it and get something out of it. Thanks again. I'm David Pipe, and I'm with my co-host, Rob Kent from eXp Realty, and we'd love to help you find your next house.
Yep.
Thanks.